What's going on, goats? My name is Raymo, and welcome back to BooKoo Bucks. Today is going to be day 5 of the ICT speedrun. If you guys don't know what this is basically me breaking down 275 hours worth of ICT content. And today will be day 5. We'll be going over the core content month 4, parts 1 through 9. And also, shout out to Lumi Traders for helping me create this roadmap. So, without further ado, let's go ahead and break down the key highlights. Day 5, core content month 4, interest rate effects on currency trades, smart money accumulation, and distribution. Interest rates are the single most influential driving force behind market moves. Understanding interest rates, shifts, and changes can assist you in selecting trades. Technical analysis of key interest rates can unlock professional money movement. Interest triads provide a visual depiction of smart money accumulation and distribution. Interest rate triads, 30-year bond, key long-term interest rate, 10-year note, intermediate term interest rate, 5-year note, short-term interest rate, and overlaying or comparative analysis on these three interest rates unlock price action, and failure swings at opportunistic times can validate institutional order flow. And in the next pages, we'll go ahead and break down these two sections. What smart money looks like in price. The base asset could be the Dow Jones Industrial if you are trading stocks, the dollar index for currencies, or the CRB index if you are trading commodities. The smart money distribution can be seen by comparable assets that are closely correlated that are making lower highs. The reason why this is occurring is because smart money is heavily distributing while the base asset or benchmark is moving higher. The public or less informed traders will be looking at the market moving higher and attribute that as this is underlying strength, so it should continue to rise. If the general market averages start making lower highs, that's actually indicating their smart money distribution is underway. And the same thing but flipped for the bullish conditions, and we'll break these both down more in detail in the next page over. Interest rate triad. We have the 30-year T-bond market, the 10-year note market, and the 5-year note market. Overlaying these three markets will highlight when accumulation and distribution in the interest rate market takes place from a smart money perspective. The three interest rates should confirm each higher low or lower high. Higher high or lower low. At moments when the USDX is at a significant price point, failure swings highlight smart money participation in the markets and trading opportunities are validated. There is no demand on either one of these three being the failed low or high. You just need one to break the pattern. When one fails to follow the other two, that shows there is an interest rate shift, so there's going to be a shift in the marketplace. And if this occurs in a moment when you are identifying a potential institutional order reference point or focal point in the US dollar index, that confirms that particular idea for that instance. So in this example, using a line chart, we can see that the first market makes a lower low, the second one makes a higher low, and the third one makes a lower low. So as you can see, the second one is the one that is not in sync. It is not making a lower low like the other two. Whenever we have something of this nature, we can understand that most likely there is going to be a shift in the marketplace. Once again, it doesn't matter which market fails to make that swing point. In this case, it could be the 30-year, it could be the 10 or the 5-year. As long as one fails to make that swing point, we are going to identify this as a shift or a potential shift coming in the marketplace. You can see the 5-year bond market have a higher high when the other two made a lower high or equal high. So in here we have a live example. On this very first one, we have price making a lower high. The second one, price basically makes a relative equal high. But as you can see, if you want to be very technical, it does make a lower high. But the third one actually makes a higher high. So when we see this, we understand that the market is most likely going to shift directions, and we can use that with our technical analysis. When you see this divergence happen, it will most likely cause a shift in the markets and affect the US dollar index. So if we go back when price was making these lower highs, and of course this one made a higher high, this is showing that most likely there's going to be a shift in the market, and we can use this to help us figure out what the dollar index is going to do. So when we come over here and we see price make a new lower low, we'll see that we had that triad or that divergence using the triad on the other page. We can have a clear understanding or a high probability understanding that the US index is going to switch directions, as we can see right here. If you can anticipate the US dollar to rally higher, then you can expect a pair like Euro USD to fall. So obviously, since the US dollar is gaining strength, how is that going to play a role when trading Euro USD? Well, the fact that USD is on the back end, if the strength of the US dollar were to rise, that would cause Euro USD to fall. So looking at EU on this time frame or during this time frame of seeing that divergence of the 5-year bond market and then seeing that there was a lower low on the US dollar index, we can understand that most likely EU is going to fall lower as we can see right here on this image. To quickly backtrack and elaborate on this a tad bit more, to be honest, I think it would make more sense to kind of ignore these images and just focus on these images here. I think it makes more sense. But long story short, ultimately, I believe there should be another line because whatever you're trading, you're going to be using two other markets to help you identify whatever you are trading is most likely going to do. So, for example, if we are trading Euro USD, we also may be looking at the dollar index and then also looking at interest rates as well. If we can see that EU is pushing higher and then we see the US dollar continuing to push higher, but we can see that interest rates are actually showing us signs that the dollar is not going to continue to push higher and that most likely if is the case is going to affect euro USD or whatever currency pair we are trading. So I'm just trying to tie these two together. Like I said, if it is kind of confusing, I don't I do understand it because I think these images are kind of confusing. But if you do understand what I'm saying here, I think you should overall be good. ICT action plan. Use the points of focus taught in the first month of the mentorship. When price action trades to a focus point like a order block, liquidity pool, liquidity void, or fair value gap, refer to the interest rate triad and USDX to confirm smart money is behind your trade idea. If there is no obvious indication they are moving large funds, pass on the trade idea and look for new ones that do. So ultimately, when you have a focus point, such as an order block, liquidity pool, or even a fair value gap, and you are potentially looking to find an entry in these areas on whatever pair you are trading, go ahead and use the interest rate triad and the USDX to confirm that smart money is in this area and also coincides with your overall trading idea. Ultimately, if you don't see that divergence or signs that price is going to go in your favor, then obviously do not trade it and look for new ones that do. Month four, reinforcing liquidity concepts and price delivery. External range liquidity. The current trading range will have buy side liquidity above the range or high. The current trading range will have sell side liquidity below the range or low. Runs on liquidity. Seek to pair orders with the pending order liquidity, liquidity pools. External range liquidity runs can be low resistance or high resistance in nature. Internal range liquidity. When current trading range is likely to maintain, liquidity voids will fill in gap risk. When current trading range is likely to remain, fair value gaps will fill in gap risk. Gap risk is simply when the market quickly reprices to a level where there was very little or no trading. In other words, when we see a liquidity run to close in a range where there's only like one candle, usually really long, usually that is a gap fill. Whenever you are in a long and you have a big gap underneath you, that is gap risk. The market will sometimes reprice aggressively that close in those ranges and stop you out. Order blocks inside the trading range will be populated with new buy and sell orders, and market maker buy and sell models will form inside trading ranges. Predominantly, entries are internal range liquidity and exits are external range liquidity. Your perspective of internal and external range liquidity will depend on the time frame and context in which you are looking at the chart. For example, if you anticipate the monthly charts to pull back up before going lower, you will notice that the daily break above highs. Those highs are the daily, maybe external liquidity areas, but in reference to the monthly, those highs are still internal liquidity areas. We do not ever try to call a high or low in the marketplace. We find logical areas where price is likely to go and then evaluate what it wants to do from there. So, simply put, external range liquidity will be the liquidity resting above or below the range. For example, to keep it very simple, if price is in consolidation moving sideways, there's going to be external liquidity above the highs and external liquidity below the lows. Once again, it is at the extreme areas above the highs and below the lows. Now, internal range liquidity is going to be the liquidity within the range. Usually, if there is enough liquidity within the range to be taken, so the banks can fill their orders and push price higher or lower, the banks will maintain the range, use the liquidity within it, and then move price in the anticipated direction that they wanted. But if there's not enough liquidity within the range, within that internal range, it's going to seek the external range liquidity. Because once again, there's not enough liquidity within the range, so they will seek extra or more liquidity outside of it. And usually, when dealing with internal range liquidity, it's going to be used or paired with liquidity voids or fair value gaps. We haven't gone in too much detail to know exactly what those things are, but I know he will very soon. But to keep it very simple, when you see those gaps in the market, price will most likely want to come in and fill those areas. And this is basically what he's referring to gap risk. So if you are trying to take a trade and you see a big gap or a fair value gap underneath your long order or above your short order, you might want to be very careful because usually or sometimes price will come up and fill those areas, stopping you out before pushing in the direction that you probably anticipated. Another thing to highlight is predominantly entries are internal range liquidity and exits are external range liquidity. To keep it very simple, let's imagine we are in bullish structure. As price is making higher highs and higher lows, as it pulls back to make that higher low, it is going to seek internal range liquidity because it's going to be taking out liquidity that is within the range. After price makes that higher low and pushes on higher, what is it trying to make? It is trying to make a higher high. Therefore, it is going to take out the previous structure high, which is going to be external range liquidity. So long story short, ultimately, predominantly I should say, because not all the time, predominantly price will pull back, take out internal liquidity, and then shoot for new highs, which will be the external liquidity. Also, your perspective of internal and external range liquidity will depend on the time frame that you're looking at. Like I give here in the example, if price is bearish on the monthly time frame, we anticipate price to pull back, make a lower high, and then move on lower. Well, as it pulls back, most likely if we go down to the daily time frame, maybe even the 4-hour time frame, we may see those ranges where price is breaking. Now, although it is breaking those ranges, and you will say, well, since it's breaking a range, it has to be breaking external liquidity or seeking external liquidity, which will be true relative to that time frame. But we also understand that on the monthly time frame, price is pulling back to make a lower high before pushing on lower. So since it is simply pulling on back, but it is still within the bearish range of the monthly time frame, price relative to the monthly time frame is simply taking out internal liquidity. Yes, on the 4-hour, maybe the daily, you can consider those external ranges, external liquidity points getting ran or taken out. And another good point, we are not here to call out the high or the low in the market. We're simply trying to find logical areas and evaluate what price wants to do from there. Month 4 order blocks. Bullish order block. Definition: the lowest candle or price bar with a down close that has the most range between open to close and is near a support level. Validation: when the high of the lowest down candle or price bar is traded through by a later formed candle or price bar. Entry techniques: when price trades higher away from the bullish order block and then returns to the bullish order block candle or price bar high, this is bullish. Defining risk: the low of the bullish order block is the location of a relatively safe stop loss placement. Just below the 50% of the order block total range is also considered to be a good location to raise the stop loss after price runs away from the bullish order block to reduce risk when applicable. So all an order block is we are going to have a black bearish candle, which represents the down move. And then we follow this by a bullish up move, which is represented by green, and price closes above the open of this bearish candlestick. When we have this is an order block, and ideally we want to see this happen at a support level. Now, when it comes to entering off order blocks, we simply want to wait for price to come back to the opening of this candle, and we can basically enter there. And our stop loss should be underneath the low of the down candle. Once price moves away, we could potentially move it on up to the mean threshold of the bearish candle or the 50% of the order block stated here. Once price breaks above the first bearish candle's high, the order block is validated. You want to see price come back down into that area and look for longs. Primarily use the bodies of the candle for now, but in the future we will elaborate on when to use wicks. You can use the mean threshold of the order block as a stop loss placement, use the low as a protective stop. So as we've already gone over, once price gives that bullish order block, we can wait for price to pull back to the open. And once it taps there, we can basically enter a long position. Now, when it comes to a stop loss, ideally a protective stop loss will be underneath the entire order block, but we could use the mean threshold of this bearish candle or just simply the order block. And the mean threshold is the 50% of this area, and then look for higher prices. As we long here, we're looking for price to run on higher to pair long exits with buy stops. Also, as we stated before, we're looking for price to pull back and seek out internal range liquidity and looking for price to take out external range liquidity. Liquidity based bias, monthly chart bearish, weekly chart bearish, and daily chart bearish. Intraday charts 4 hour and less will be correcting or retracing higher. This is where you anticipate the market to enter a premium and seek buy side liquidity to sell to. Protective buy stop raids or returns to bearish order blocks or fair value gaps and or filling of a liquidity void, each offering a potential low resistance liquidity run, shorting for a target under a recent low. Simply put, when the higher time frames are aligned and going bearish, the lower time frames may be going bullish, and if so, you understand it is a retracement relative to the higher time frames. You can then look to short at these POIs. You can flip/reverse everything for when the monthly, weekly, and daily charts are bullish. So I kind of already summed this one up, but basically, if you understand that the higher time frames are bearish and the lower time frames are going bullish, you understand that it is simply a retracement trade. And from here, you want to identify shorting opportunities from the specific POIs. Remember, an order block should be supported by the higher time frame. If it does not, you should not use it. So for this example, if we are bullish, we can look to buy off of bullish order blocks. If the higher time frame is bullish, yes, this is a bearish order block. But would we want to short off of this one? No. Why? Because the higher time frame is bullish. So basically, keep in mind the higher time frame and try to follow alongside of it. Mitigation blocks. When the market has given clear indications that it wants to break down or move higher in a step ladder formation, in other words, selling rallies or buying declines. For this example, let's look at a bearish scenario. The reference point can be almost anything such as an old high or low, bearish order block, or even a breaker, some form of resistance. When price hits this level, we want to see if price shows willingness to continue higher or go lower. We can see price create an M pattern by its failure swing with a confirmation break in market structure. So as we can see here, this is the resistance level or some type of POI. If we see price taps into it, makes a higher low, fails to make a new swing higher high, and then price continues to fall lower, this is considered a market structure shift. This short-term rally in price highlights a specific institutional reference point known as the mitigation block. So as you can see here, from this push on up, before price went lower, this will be the mitigation block. We watch this range because there has been buyers, but those buys are underwater. Your attention moves to the low that was broken, focusing on the last down candle. When price action returns to the A point of reference, the long positions taken from A to B price swing will have an opportunity to liquidate or mitigate the net loss that occurred when price dropped from B to C. This can result in new lower price swings to C for retesting, or significantly lower prices into the support level under market price. So, as stated here, the reason why we want to highlight this area is because we understand that there were buyers in this area, but they are currently underwater or in drawdown. Think of it this way: as price was pushing on higher, from a simple perspective, you would anticipate price to continue to push on higher. Obviously, we're looking for shorts because we tapped into a POI, but once again, keeping it very simple, there are going to be buyers in this area looking for price to push on higher and make a new swing higher high. So as price pushes on lower, these buyers are in drawdown, or as ICT says, underwater. So what they are anticipating price to do is to pull back up into this area so they can close those positions either at near break even, maybe with a small loss, or even maybe with a small win. But the idea is they want to get out of that trade because they no longer trust or believe price will continue to go on higher. So they're just trying to get out and mitigate their loss. And as we see here, price pulls back and continues to go on lower. Do the longs in here need to be mitigated? We do not know for certain if these longs need to be mitigated, but the same process can be repeated as price continues to drop. This pattern/scenario is known as buyer's remorse, as buyers are longing off the small bullish move, but bail on the trade as price is not looking to be in their favor. So since we know those buyers want to get out of the market, we allow price to pull back on up. And as they close those buy positions, we can then look to enter shorts and anticipate price to then go on lower. Now, as you see here, we basically have the exact same pattern. We have another mitigation block. And right here, ICT is asking, do the longs in here need to be mitigated? Well, we don't know for certain, but it for sure could. And if it does, we repeat the process as we anticipate price to continue to push on lower. Here's an example of just breaking down what we just went over a tad bit more. And then here is a real life example of price coming back on up to tap into those mitigation blocks before continuing to push on lower. ICT breaker block, bullish scenario. The reference point can be almost anything such as an old high or low, bearish order block, or even a breaker, some form of resistance. Price makes a short term low, pulls back higher, creates a short term high, and then eventually makes a new short term low dropping into the reference point. This could be looked at as a false breakout or turtle soup buy. When price breaks above the short term high that led into the short term low, this is a market structure shift. The high broken is what you focus on. Wait for price to come back down into that old high. There are still short orders there that need to be mitigated. So this right here is a bullish breaker. We can see there is a structure or just a swing high that leads into a low. Once price taps into a reference point, in this case a support level of some sort, once price taps into it and then pushes on higher, giving us a new swing higher high, we can then look at the previous high and use that as a bullish breaker. And the idea is price will pull back, tap into this breaker before pushing on higher. And very similar to the mitigation block, we anticipate price to pull back, tap into this area before continuing to push on higher. And the reason being is because there still may be short orders in this area that need to be closed and mitigated. And then we have the same thing but flipped for the bearish scenario. We see price pushing bullish or pushing higher, tapping into a resistance level or some form of POI. And then after price makes a new swing low, we can anticipate price to pull back into the bearish breaker because we understand that there are still buy orders resting in this area that need to be mitigated before price pushes on lower. Ideal setup in major to intermediate term downtrends. Bearish breaker block is a bearish range or down close candle in the most recent swing low prior to an old high being violated. The buyers that buy this low and later see the same swing low violated will look to mitigate the loss. When price returns back to the swing low, this is a bearish trade setup worth considering. Same but flipped for the bullish breaker block. So this is the exact same thing we went over, but this is in a bit more detail. We have price pushing on higher, and we have the rate on buy stops, and that indicates buyers are trapped long. The buy stops be resting above this swing high right here. And then after that, we have repricing lower after buy stops are taken, which causes price to make this new low. Market structure broken down, and retracements will be new selling opportunities. So we anticipate price to retrace, and then we look for shorting opportunities after the retracement is done. And we're using the breaker block to find that entry before price potentially goes on lower. Same thing but flipped for the bullish scenario. Price is pushing on lower. We have a rate on stops. Reprices higher. Makes a new swing high. We anticipate price to pull on lower, give us a retracement, and then take a long off the breaker block and anticipate price to push on higher. And then down here, we just have a real life example of a bullish breaker block in play. Month 4, ICT rejection block. Ideal setup in major to intermediate term downtrends. Bearish rejection block is when you mark the highest high and the highest open or close in the swing high. It does not matter if the highest candle is bearish or a bullish candle. Bearish rejection block is when a price high has formed with long wicks on the highs or high of the candle or candlesticks, and price reaches up above the body of the candle or candles to run buy side liquidity out before price declines. So all we're doing here is marking up the wicks before price reversed on lower. So here we're marking up the wick high, which will be the easiest point to spot, and then we're marking up the highest close or open of a candle. Again, it doesn't have to be the open or the close, it can be either or. Also, it can be a bullish or bearish candle. So on this real example, we have the wick high, which is up here, and then we're using the highest, in this case, open point of this candlestick. Again, it could be the close, but it just depends on which one is higher. It doesn't matter which one is higher. We just have to find which one is higher, of course. Another one here, we're going to use the wick high all the way down here to the candle close high. So the difference here, we're actually using wick high down to the candle open high, and then we have the wick high down to the candle close high. Whichever one is higher, whether it's bullish or bearish, that is what we are going to use. Now, when we spot this area, that is going to be the rejection block that we could potentially use as an entry point. So here we have a rejection block, price comes in, taps into it, and falls on lower. Same thing here, we have a rejection block, price taps in, and then falls on lower. Same thing but flipped for a bullish rejection block. Bullish rejection block is when a price low has formed with long wicks on the low or lows of the candle or candles, and price reaches down below the body of the candle or candles to run sell side liquidity out before price rises. So same thing, but we're going to see price move lower before pushing on higher. And then from here, we're going to use the lowest of the wicks, and then we're going to use the lowest of the candlestick open or close, whether it's bullish or bearish. So in this case, this is the wick low, pretty simple, pretty self-explanatory. Now over here, we're going to use the candlestick closure because this is the lowest price point within the candle's body. Why am I not using this one? Because this candlestick open is higher than this candlestick's close. So whichever one is lower, whether it's bullish or bearish, open or close, whatever is lower, we're going to be using that one. So for example, in this image down here, we're going to use the wick low and we're going to be using this candlestick closure. In this case, also this candlestick open doesn't matter because they're at the exact same point. But either way, that is the lowest of the candlestick bodies. And this is going to form the bullish rejection block. As we can see, price comes in, taps into it, and reverses on higher. Month 4 reclaimed ICT order block. Market maker buy model. Essentially, when the market drops down and has a price swing lower, reaching into a higher time frame or immediate term support level, the idea is that we are going to be anticipating that market move lower until price hits that support level to watch for reclaimed order blocks. On the sell side of the curve, market makers are going to be scaling in early because their positions are much larger than ours. These will create short term lows in the market. The level of support it is reaching for is most likely going to be the ultimate price level it's going to have its impulse swing from. Eventually, price will move higher off of a support level and we will start seeing the buy side of the curve. As it does, we will begin to focus on old candle or old down candles during the sell side of the curve. Every time there was a bullish order block created on the major price swing going lower, that indicates hedging was going on, and that down candle is what we are going to be looking to reclaim. Every new buy opportunity is going to be matched up to the previous down candle from the sell side of the curve. So he doesn't break it down too much in this video, maybe he does in the future, but long story short, if you don't know, the banks are not able to just place one huge large order in the market for them to fill all their orders before pushing price in whatever direction they want. In this case, let's use the example of price or the banks looking too long and push price on higher. Whenever they are looking too long, they have so much orders that there's not enough liquidity in the market at that one specific time. So they have to break up their orders. So even though they're breaking up their orders, they're getting in a relatively same area. Since they're relatively bonded in the same area, it's almost as if they're taking one big order. But once again, they can't do it in one go, so they have to split it up. So in this image down here, as price is pushing on lower to tap into that POI or some type of support level, the banks are going to buy at this blue line, push on lower, buy again, push on lower, and then buy again, push on lower before price pushes on higher. So as you can see, they are buying on the way down, but they're doing that because they can't buy all in one go, so they're splitting it up. Although they are at different price points, ultimately it's going to be relatively in the same area for them, and price is still going to push on higher as they anticipated. Also keep in mind that once price hits the designated area and they have all their orders filled or all the liquidity they needed to fill their orders, you're going to most likely have a very large impulsive move after price has finished accumulating or filling all their buy or long orders. Now, it's not shown in this image right here, but long story short, when we are looking at these hedges or these short term buy moves where the banks were longing, we're going to be looking at some down candles over here and using these order blocks as reclaimed order blocks to potentially long off of and see price continue to push on higher. Ideal setup in major to intermediate term uptrends. Bullish reclaimed order block is a candle or bar that was previously used to buy price, and a short term bounce confirms minor displacement. In the buy side of the curve, these old blocks will be reclaimed longs. Now in this image here, this is going to be price pushing on lower before pushing on higher, and this side is going to be the sell side of the curve, and this right side will be the buy side of the curve. Now, what we're doing is we are identifying the last down move before the bank spot. So right here, we have a down move before the bank spot. So when we spot this area or this last down move, we're going to mark it up. And what usually happens as price is on the buy side of the curve, price will use that as a reclaimed order block before pushing on higher. Same thing over here before the bank spot, they ended up selling. So we're going to mark up this bearish candle or this last sell move before they bought. And if we drag this line all the way out, this is going to be the reclaimed order block on the buy side of the curve that we're looking to use to continue to long and continue to see price push on higher. Same thing but flipped for the bearish reclaimed order blocks. Ideal setup in major to intermediate term downtrends. Bearish reclaimed order block is a candle or bar that was previously used to sell price, and a short term decline confirms minor displacement. In the sell side of the curve, these old blocks will be reclaimed shorts. So once again, same thing but flipped. As the banks are trying to move the market on lower, they cannot sell all their orders in one go. So they have to split up their orders, sell along the way before pushing price on lower. So right here on the buy side of the curve, as price is coming up towards a resistance level, the banks are selling, pushing higher, selling, pushing higher, selling, pushing higher, and then we have a big sell-off move, which is usually going to be an impulsive move, or also known as displacement. Now, as we are on the sell side of the curve at this point, we are looking to spot the reclaimed order blocks to continue to sell off of. So with this real image here, the banks bought before they sold. This is the last buy move before they sold. And again, the last buy move before they sold. And when we highlight these areas or draw a line out from these areas, usually the banks will come back, reclaim that order block, push on lower, reclaim the order block, push on lower. And then same thing here, price comes in, taps it, reclaims the order block, and then continues to push on lower. Month 4, ICT propulsion block. Ideal setup in major to intermediate term uptrends. Bearish propulsion block is a candle or bar that has previously traded down into a candle or bullish order block and takes over the role of price support for higher price movement. This order block will be highly sensitive and should never see the mean threshold break. So simply put, when you have order blocks stacked on order blocks, that is going to form some form of a propulsion block. Right here, we have one order block, price comes back, taps into it, creates another order block, and this right here is going to be the propulsion block as these order blocks are stacked on top of each other. And usually when this happens, price is going to be very sensitive, tap into this, and move aggressively away. So this right here is the live example that he gave. This entire move is going to be the sell move before price pushing higher, creating this entire move as an order block. Yes, technically this isn't the classic sell to buy move based off of a 2 candlestick pattern, but in this case, he's using the entire sell move to this entire buy move, if that makes sense. Either way, price makes a new higher high, price pulls back, taps into this order block. As it taps into it, at the same time, when price pushes on higher, it creates another order block. So we have that scenario of price creating an order block and then creating another order block on top of it. In this case, he does not identify this as a propulsion block. What he shows here is that price makes a new high, pulls back, taps into this order block, and this order block here is the propulsion block. So I know in this case, he highlights the second one as the propulsion block. I don't know if it always has to be the second or sometimes it's the third. I think ultimately, as long as the order blocks are stacked on top of each other, it's basically always going to create a new propulsion block, I'm assuming. So just keep that in mind. In this case, technically, this is the third order block. He doesn't classify the second one as a propulsion block. But here, there's the third one, price pulls back, taps into it, and then we have quite a quick and impulsive move away from it. Month 4, ICT vacuum block. Bullish vacuum block is a gap created in price action as a result of a volatility event. The gap forms by a vacuum of liquidity directly related to an event. NFP can create a vacuum block or in futures, a session opening gap or a session opening can. If we see this after price has been in a prolonged uptrend, this potentially is going to be an exhaustion gap, which is a graphic depiction of capitulation or also known as the last bit of momentum. There is a high probability that the market will want to come back and try to close that because no trades are being made in that range. Even though there is no candle there, we can treat it just like any other. So a vacuum block is just when price makes a literal gap in the market, and usually this is caused due to news events. Now, when we see a vacuum block, We can look at it two ways. One, in a scenario where price has been bullish and then we tap into some type of POI, or we anticipate price to reverse bullish from this area. If we see that vacuum block, this is a good sign that price is going to continue to go bullish. Now, if we see that price has been bullish for quite some time, it's overextended, and then we're anticipating price to reverse and go bearish at some point, if we see a vacuum block like this, most likely this is some form of an exhaustion move and a sign that price is not going to continue to go higher, but instead push on lower. But either way, when we see this vacuum block, we pretend that there is a candlestick there with a open, low, high, close, all that good stuff, and we just imagine it is there in that area. And when we see this, we usually anticipate price to come back into this area before continuing to go higher or lower. You could potentially look to buy at the opening of the order block, but you want to see immediate feedback if you do. So if you don't realize this, this is a sell to buy move. Price could simply be coming back down, partially filling the gap, partially filling that vacuum block, but simply mitigating the order block to push on higher. Although that is a possibility, ultimately, if we are looking to long and make a move off of this play, we want to see immediate feedback. If we're not getting an impulsive move or immediate feedback off of this order block, then most likely price will want to push on lower and fill the gap a bit more. If price completely fills the vacuum block, this is a perfect delivery price and everything is balanced out. We will want to take longs here. If price does react slash go bullish after filling the area, we will not want to see price fall lower than the level that would have closed or caused it to close the gap. A vacuum block can also be referred to as a breakaway gap. So ideally in a bullish scenario, we want to see price completely fill the gap, and once it does, we can look for longs. Now, after we see this and price pushes on away, we ideally do not want to see price close underneath or get underneath this level. So if we're on longs and let's say we put our stop loss underneath the low of this candlestick body or wick low, whatever it is, if we see price reverse and push on higher, this is a good sign that price is going to continue to go higher. And most likely we can move our stop loss underneath this area because again, we don't anticipate price to push on lower. So it's just a way of potentially refining our risk or potentially entering and having a stop loss minimized so we can have a greater trade setup. Now, that is it for day 5 notes. If you guys do want these notes for absolutely free, they'll be available in the link in the bio inside my free WAP. If you guys have any comments, questions, or concerns, please drop them down below. Thank you for watching, and I will catch you in the next one.